Assalamu alaikum. This is Abdul Wakil Nazari, and I would like to welcome you to my YouTube channel. Today, I came with a new lecture regarding trading. Uh, that one of the vital topic, or that every individual is trying to learn this and trying to earn money from the market, especially from financial market. From financial market, taking money is not easy. It's a bit risky. So so that's why I came up with these lectures in order to make you a bit aware about the financial market, how the financial market operates. And it's not easy as we think. Like, everyone wants to have a passive income. The passive income, like, that you don't want to struggle, you don't want hard work, you want to sit in a place where money comes and you enjoy your life in a loss of, like, a loss of imaginations, life that you want to explore, you want to see the world. Like, it will happen when money works for you and you enjoy your life. Now, that's what the mindset and the mentality of a people that they want to be in a trading. Now, if you are coming to the trading with the mindset of this mindset that you will be free of life and you will invest or buy shares or anything, and then that shares will make profit to for you out of nowhere, and you will moving on and you enjoy, the money will come. So then it's not like this. No, trading is a different world. I've been in this field from the last of 3 years in and on. But along with the trading, I have full-time job that I'm doing it. I haven't quit my job and to start trading. I'm doing my job and plus doing my trading too. Because you can't you cannot be you cannot be all the time, all you will focus on your trading rather than to have to leave your full-time job. Yeah, in one time you can, but you need a support, you need a backup, financial backup, because you will face a loss of challenges in the market. It doesn't mean that you put your money and the next day you will earn profit and you will take it out and you enjoy. And no, it's not happen like this. The way you think, the way market think is completely different, because you're competing with the market. When you want to be a trader, it means you are coming out in the market and you open challenging other traders that I'm gonna snatch the amount of money from you guys and to put in my pocket. It means it's simple. You're snatching the money from others and putting in your pocket. But that snatching needs a strategy. It needs complete, proper planning, proper learning. That's why I come up with this. It's not about all the time about the numericals. Trading is not all the time about the numericals. You understand about it, but it's not all about your numericals. It's not all about tactical or fundamental analysis of it. It is, but not all. That's why. Now let's start with the lecture. This book that I've started the lectures from this. and I believe this is one of the best books that I have ever read. Now, actually, this book is mostly about the trader mindset. It develops your mindset. It gives you a kind of confidence to handle every situation when you face in the market. Now, the book name is Trading in the Zone by Mark Douglas, one of the best books. Now, the first chapter, The Road to Success. The Road to Success, where in the first chapter, the author is focusing on three things: fundamental, fundamental, technical, and mental analysis. He just come up with the summarize on differentiate these three things. That in trading there is three things: fundamental analysis, technical analysis, and mental analysis. It means you're taking decisions on the basis of fundamental analysis. You're taking decisions on the basis of technical analysis. You're making decisions on a base of your mental analysis. It means it's all about your decisions. It means it's all about your next step. Now see, Mark Douglas, he said that he asked one question, that what truly what truly determines trading success. What truly determines trading success. Now that's why he come up with three things. Number one, he introduced three forms of the analysis, like this: number one, fundamental analysis, technical analysis, and mental analysis. But again, he said the mental analysis is a is the most vital consistent result. It means if you have knowledge, or if you have complete understanding of fundamental analysis, if you have complete understanding of technical analysis, still these two forms of analysis won't give you consistent result. But what will give you? Only thing that will give you is consistent result, that is your mental analysis. That's your what? Mental analysis. That's why the Mark Dougal is mainly focused on mental analysis. He said that mental analysis is one of the vital or consistent result, is giving you vital and more important, and giving you a consistent result while you're entering with your mental. And now what does mean mental analysis? Now moving ahead, we will study about this too. Now see three things: fundamental analysis. Fundamental analysis is a study of intrinsic value and economic conditions. Now again, if we talk about intrinsic values, now what do you mean by intrinsic values? Intrinsic values and economic conditions. Now, for example, if you want to invest, or if you want to buy any company shares, so what are you going to do that first? You evaluate the complete performance of the company, the balance sheet, the income statement, the cash flow, the outflow, the liabilities, the assets, the post performances, you evaluate all the things that you see. Okay, if I'm going to buy a share of this company, right? If I'm a shares of share, if I'm going to buy the share of the company of company A, B, C, D. Now see, now you are going to what? You're going to a timeline. Okay, company A, what this company has done from the last of couple of years. Year 1, 2, 3, 4, previously years. Now again, you see the revenue of it. Now what was the completely you observe the company, the you know the financial value, and see the company is consistently growing from year 1, 2, 3, 4. Now company is giving dividend. Company is profitable. Now you see, you observe it, the beta value, the R, return of, return of equity, like what is return, what is it positive or negative? Now again, the second one is that's about technical ones. As about technicals. Technical analysis examine the price movement and the patterns. In technical analysis, what you are doing, you're looking the prices, movements, and also you're looking the patterns, the charts. You're looking the charts. Now, looking the charts, looking the candles, and on the basis of charts, candles, you observe. You observe the price movements, like about the timeline, 5 minutes, 30 minutes, an hour, 2 hour. Now these two lines, according to the hours, according to the chart volumes, according to the interest of the people, according to the movement average, you see the RSI, the value of RSI. What is the value of RSI? Whether it is below 30% or above the 30%. You're looking at the value and the value of MACD, and you're looking for that, whether the line and the green line, there's a line, you see the line. So on the basis of technical analysis, you're looking for the charts, you're looking for the figures, you're looking for the indicators, you're looking for all the indicators, and you see that. Okay, then on the basis of that, you take a decisions, and I'll see there's a value and that much liquidation is there, and there's a chart, and you're looking all mathematical, or you do your calculations, and then you enter the market. Now, sometime when we enter the market, what we enter with which perspective we are entering the market, sometimes it not goes to according to that. It not goes. What happened? Our technical analysis, what we perceive, okay, market will move like this, but in the reality, when we enter the market will goes somewhere else. Suddenly goes to, we believe, okay, the market is a now bullish market, but eventually when we enter after 5 minutes, the market become bearish. That's it. How? Now that's what the technical analysis is, that you are moving on the basis of price. Now the next one, that is about mental analysis, which McDougall says set one of the vital market, one of the vital important analysis among these three analyses. Now the mental analysis is a focus on psychology, mindset, and behavior management. Psychology, mindset, and behavior management. Behavior management. In technical analysis, you do your all technical aspects work. You enter the market. And with the fundamental, you do your all mathematical analysis. You collect the all mathematical objectives. Okay, that's fine. Now, when it comes to technical analysis, you do your all technical, you chart reading, you do the chart reading, candlesticks, you all the chart, all the indicators, you apply the indicators. You see the price averaging, price average, movement average. You see that, you see the volume of, use every angle of technical analysis. You apply that. Now, what if the market goes against your theory, against your strategy? What will you do then? Again, what will you do? Definitely, you will panic. When you panic, what are you going to do? You take a decisions, and uh, you know, definitely, when you take a decisions on a panic situations, you always going toward the losses. That's why the McDougall says that the best trader, if you want to be a best trader, if you want to be a best trader, it doesn't mean that you have a knowledge, full knowledge. It means how much control you have on your mindset, on your behavior. The best trader, one thing is that the best traders, they won't, they will not lose their disciplines. No matter what happened, no matter what happened to the market, but they control their emotions. They control their emotions. They they will not move according to the market emotions. They will not move according to the market emotions. The market change, market goes up, market goes down, but they remain steady. They remain their level of calmness on one level. They won't go high. When they get a profit, they will not, you know, they will not, like too much overexcited. They're not overexcited when they're making too much profit. When they're coming down, they'll not get a panic that, oh, I have a loss. Whatever happens, the emotions remain same. Now, next one. See, as I discussed about fundamental analysis, I said fundamental analysis the market, evaluate the market using economic and financial data. It means that on the basis of data, you observe the company, the values, the market, the how much operating capital it has, previously the balance sheet, the income statement, complete the process with the company showing all the data. He observed all the data, the liability, the revenue, the profit, observing that every aspect, what people said, what news, what people talk about, what the employees are saying about this. So everything they observe it. That's about economic and financial data. So they evaluate every aspect of economical data of a company internally. The next, effective over the, but as I said, fundamental analysis is effective. It's not. I'm not saying it's not effective. I'm not saying it's not effective. It's very effective. Fundamental analysis is one of the effective. That's good. That's a. It's a. It help you out for the ground. You know, the knowledge you getting. With when fundamental analysis, the wisdom that you are gain, it will help you. It will help you in mental in a technical analysis. It will help you in a mental analysis. But to rely on fundamental analysis, holistically, all alone, everything you depend on fundamental analysis, that is not effective. That's why we're saying not wholly dependent on a fundamental analysis. Fundamental analysis is one of the part of learning process. Now that's why we're saying that fundamental analysis is effective only for the long-term growth. What? For the long-term growth. Now, if you are year one and you observing the company financial position of year one, the performance in year one, now you can predict this company in year 5. You can predict the company, the performance in year 5. That after 5 years where the company will be. And if the share price of the company is $1, yeah, £1, so what will be the share price of the company after 5 years? Fundamental analysis can predict this. It can predict this. The timeline from one to another. 5 years timeline, you can predict it. But it cannot be, that's why we can say that, but often unreliable for a short-term predictions. It cannot be reliable in short-term predictions, like from year 1 to year 2, or from this month to the next month. It cannot be dependent on. We cannot be dependent on this. That's why we're saying that market movement are influenced by emotions and making timing difficult. Now again, this is the timeline. With the fundamental analysis, you can predict from point 1 to point 2. But what happened between this line, what is happening between this line, the fundamental analysis cannot predict. What movements are coming in here, what ups and downs are coming in here, it cannot be predicted by fundamental analysis. Simple as that. That's why we cannot wholly depend it on fundamental analysis and to take a decision holistically. Yeah, that's good for only future, for long-term investment. If you want to invest for the long term, you can go with the fundamental analysis. That's a brilliant idea. Sit back, invest once and set it back and see what will happen after 5 years and 10 years. That's good. But if you want to continuously operate in the market and daily basis, every day, every single hours in the market, so you cannot be rely with the fundamental analysis. So you have to come up with the another analysis. So that's what we have. Next one, we have technical analysis. Technical analysis, we can see technical analysis, we see uses the price charts, indicators, and behavioral patterns. As I said earlier, and with the technical analysis, what you're going to do? You are using the charts. You are using the indicators and the behavioral patterns. You see the chart, you see the movement of the charts, you see the, you know, the liquidity gap, you see the upward, downward, you see, because every chart, every candle, it has a different meaning. Every candle is coming with a different information. From one candle you can observe, you can justify what next candle will be formed. From 2-3 candles you can observe, you can predict the next movement of the market. That's why I'm saying, that's why with the technical analysis you are going to read the price with the charts, indicators, you use behavioral patterns. Now based on the data, the price reflects all available informations. Based on the, based on idea that the price reflects all available informations. Whatever the reading that you are, whatever you're studying it, whatever the charts you are studying, whatever indicators you are studying, every indicator that you use, it has it has meaning in there. It tells you what is going to be happen, what is going to be happen, because every indicators, I'm going to teach you about every indicators, about the outcomes, what does it mean, why we use it, where we use it, how it can help us to take a decision on the basis of these indicators, so whether we can take decisions or not. So that indicators, what tells you about it? It tells you about the volumes, it tells you about the people's interest, it tells you about what movement, what will happen next, where the market goes, what does it mean, what chart means. There are lots of things are there. Now see, now the next one we have, say, offer. So it offer probability insight. There is a probability insight rather than clarity. Now again we cannot say by, but we cannot say that with a technical analysis our decision should be 100% right. No, we only say there is probability insight rather than certainty. With the chart reading you cannot be certain about this. That with the chart reading you can say, okay, this candle is formed, now from this to this, now the price will go up, we will say, or go down. Like sometimes we see inverted hammer, sometimes we see inverted hammer, like see some of is formed like this, it comes like this, oh, in in a red color especially, or maybe in a green color. Now when it see at the top here, now see, like for example the prices goes from here, and now eventually this one form here. Now it has meaning. What does it mean? It means that the buyer and seller, the buyer and seller, the buyer wants to price of this particular share, the price should go up, and the seller wants the price to go down. Now this is show that the buyer have strong intention, they have a strong power than the seller. It means after the next candle will form, the buyer will be dominate. Now from here it will show that the market goes back to the upward rather than downward. So that's why. So it is like a certain, we cannot say maybe go up. So it happens, maybe it go from here to come to down. Anything can happen. But you need to understand certainty is there. And that's why you have to be, that's why we can say that emotionally control, requiring emotional control. If you are dealing inside the market, you need to have emotional control. You need to have control on your emotions. That whether the price goes up or whether the price goes down, whether you make a profit, whether you make a loss, you always be in a one mood. Because when we enter the market, so always enter the market with the managing of your losses, to put stop loss, SL. Go with that, because if the price come down, so at least you lost some amount of your money, 1 pound, 2, 3 pound. But if it goes, you earn 3, 6 pound. But you put your stop loss there. That's, you know, if you're a trader, obviously, if you want to be a trader, so you are a risk taker. You have to be accept this concept, accept this, that yes, I am a risk taker. Once you accept that you are the risk taker, you are accept the risk taker, so then the market will give you a lot, because you are a risk taker. You don't care about anything what happens, whether you lose or win, nothing will happen. Risk taker, when you accept it, when you accept the risk, that will be the when you accepted the risk, from that moment the market won't bother you. It will not affect on your emotions, on your mental. Nothing will happen to you. Now, the next one, that's about mental analysis, or we can say psychological analysis. For the mental analysis, we can say that the critical factor in trading consistency. Now see, the most important factor in the trading is what? The most important factor in the trading is what? That is consistency. What? That is consistency. And the most important in the trading is, that is consistency. But what in consistency? Consistency in your behavioral pattern. Consistency in your behavioral pattern, your reactions, whether the market snatch from you everything, still nothing happened to you. That is fine. Maybe when you go with your strategy and your strategy doesn't work, so you will not be panic. Maybe your strategy does not work once, maybe strategy will not work twice, but stick on your decision, on your strategy, and find out if your strategy does not work, where the problem is. Now find out the problem and make like reform your strategies, bring some changes in that, then enter again. Maybe your technical analysis and fundamental analysis that you do, some of things are wrong. Maybe the information that you got it, that's not enough. Maybe the chart reading that you do, that's not the right way of reading charts. Maybe the indicator that you're using for the chart reading, maybe that's not proper use. Now whatever happens, but there should be a consistency, like in the trading, there's a critical factor is the consistency of on your behavior. Now the second one is, that is about involve self-awareness, emotion discipline, and risk acceptance. As I said earlier, Three things. Self-awareness. The most important factor, the self-awareness about yourself. Like if something happened in the market, like anything happened in the market about the prices, suddenly collapse, everything goes down. But it should be, you need to understand. You need to understand about yourself that yes, if anything happened that cannot be affect me. That's why. But it's trading is it's depend on your the mind and how you deal with that. If you are dealing the trading as a gambling, so that will affect your emotions. That's why we're saying trading is not a gambling. Trading is not a gambling. Gambling is something which other people controls you. Trading is something that is in your control. In gambling, it's from beginning to the end, you are under the control of others. They want you what to do. But in a trading, it's everything is in your hand. How you deal with the market, everything is up to you. You take a decision, you enter the market, you're taking decision to out from the market. It's up to you. It's up to your wisdom rather than others. The next ones. First thing, self-awareness. You need to have aware about your emotions. Next one, emotional discipline. Discipline. I said it, emotional discipline. Whatever happens, you should be calm on one status. Situation or your mental status should be same. No panic, nothing should happen to you. That's why emotional discipline is very important. Above self-awareness and emotional, you can control your self-awareness and you will be disciplined once you accept the risk. I said earlier, trading is a risky. Trading is a risky. If you are a trader, you are a risk taker, and accept this. When you accept it, yes, I'm a risk taker. That's it, finished. There is nothing to worry about it. Now only build your wisdom, build your knowledge, read books, understand the books, read the market, understand about the market. The more you read, the more you understand. That's a brilliant. The more you know about it. But if you know about the trading, if you want to be a trader, enter in the market. Enter the market, then start studying it. Do the trading with a small amount of money. Start investment with start with the investment strategies, like do the investments. Like do not go with the other like CFDs where we put the stop losses, or when you no, don't go there. So go with the put your money in an investment strategies like there's an app by the name of Trading 212. Yeah, you go with that one. That give you options of investment. Then you invest in stock, and for a weekly base or monthly base or after the week, or see the companies. Now invest the companies which is in the market cap is in a billion. As a newly investor, now when you enter the market, so invest on those companies which is their market caps are in a billion, because that will not give you loss. Is all you give you learning. So you will learn from there, and then you can find out the best later, the companies which you can make the more money. Or but there is also a lot of things going on inside the market. But you have to enter the market by knowing, like if you want to learn swimming, so you have to jump in the in the pool to learn it. Now you cannot learn from here. Jump, see, test it, then you will learn it. Now next one, that is about traders mindset, belief, direct impact, behavior and results. Trader mindsets and beliefs directly impact behavior and results. Trader mindset. So what your mindset is, how you think, how you deal to the market, how you deal your financial things, how you deal your financial losses, how you deal your ego, how you deal, when you earn the profit, when you make a profit, how you handle that one. When you losses, how you handle that one. That would affect, is directly affect. Now, from here, chapter number 1, lecture 1, that's all for today. And I'll upload the next lecture tomorrow. Thank you so much for your watching, and be with me, and we will learn lots of things, many things. I have planned huge. After that, I've been uploading all about related to money, trading, everything. Thank you so much for your attention and being with me like this for a long time. Thank you.